For the seventh time this year, the Federal Reserve raised the benchmark rate, aka the cost to borrow money, this time by 50 basis points or 0.5%. They also gave guidance on what they plan to do in 2023. Spoiler, keep rates going up. Here's a quote from Jerome Powell, the chairman of the Fed himself. There's an expectation really that inflation will not move down so quickly, so that we'll have to stay at it. So we may have to raise rates higher to get where we want it to go, ... That's why we're expecting that they will have to remain high for the time. They being rates. Let's get into how it impacts the housing market right now. Welcome back to House Rich, the first time homebuyer show where we help millennials figure out how in the world do I buy my first home. Today we're talking about the Fed's rate hike, so let's get right into it. But first, let's jump back historically. Like, how are we in this position in the first place? So, remember that thing called COVID where the Fed had to swoop in and save the economy? What happened during that time frame, and you can see on this chart, they lowered rates to a super low level, artificially low. As you can see, the cost of borrowing money was less than 0.5% during that time frame. That was to increase spending to stimulate the economy. Folks spent a little bit too much, and now there's a lot of inflation. The Fed's mandate from Congress is to combat inflation by any means. The housing market be damned. And specifically the housing market, because the majority of people's wealth is tied up in real estate, right? So when home prices are going up, folks think they have a lot more money because, hey, my $200,000 home is now worth $350,000. I'm rich, right? And so now the Fed is having to keep rates artificially high in order to bring down home prices, bring down consumer spending, and that's where we are essentially now. So as you can see on this chart, this interest rate hike that the Fed has done since March is literally historic. This is the fastest that rates have climbed since 1980 over that time frame. As you can see here, it literally is like rocketing up from the April time frame until today because the Fed raised interest rates 75 basis points, 75 basis points, 75 basis points, 75 basis points, and now 50 basis points, which is kind of looked at as, hey, wow, they're not raising it so high anymore. But when you're looking at this chart, remember, this is the bank's cost to borrow money, not your interest rate as a consumer. So when rates go up, when it costs more for lenders to borrow money, they pass the savings along to you. That's why rates were so low in the early 2020s, 2021 timeframe, because the cost to borrow money was less than 0.5%. Right now, the cost to borrow money is about 4 to 4.25%. The Fed is planning to raise that number to about 5.1% over the course of 2023. And that, of course, could decline depending on how inflation is going. This chart right here is a projection from Fannie Mae on where they think rates may go throughout the course of 2023. As you can see, rates are probably going to be in the low sixes throughout the course of 2023. But I've actually seen a report from Redfin who think rates may dip all the way down to about 5.8% in Q4. And this is once inflation gets under control. But pretty much every source I've seen has rates either in the very low sixes or high fives at some point in time. So translation, that's going to be the new norm for 2023 when it comes to interest rates. As you can see from this chart, home prices are going up at a meteoric rate ever since COVID hit and the Fed dropped the cost to borrow money down to less than 0.5% in the early 2020s. And you can see that peak going down is about the June timeframe of this year once rates hit that 5-6% threshold. So the Fed will keep rates at this high threshold until home prices come down. To be clear, their goal is not to crash the housing market. Their goal is to combat inflation. Having said that, the thing that has the biggest impact on inflation, one, is unemployment, but two is actual home prices. So home prices and inflation kind of move in tandem, even though they are directly related. So where's the 2023 housing market predicted? Let me go into the crystal ball, right? So home prices are expected to keep declining in 2023. We hit that peak like in June of this year, and they've just been going down since then, right? There's no reason for home prices all of a sudden to make a turn and take off because rates are still high and home prices are still high. There has to be some sort of give, and rates are not going to give because the Fed is controlling interest rates. So they're going to control home prices by making homes unaffordable because homes went up so quickly that they became unaffordable once the home prices did not match the low interest rate. So home price will continue to go down. The projection I saw from Redfin is that they think homes will depreciate about 3 to 4% in 2023. And that is a huge number, by the way. Typical appreciation is 1 to 4% in the housing market, and homes typically appreciate. So for home prices to go down 4%, that is a big number. But once again, perspective, let's pan out. Home prices were up 43% at a certain point in 2023. So what goes up must kind of level out, and then it'll go back up again because home prices typically just go up. Hope that helped add some clarity to what's going on with the housing market. If you got any questions, drop them down below. I'll drop a more detailed video later this week once I dig into the data a little bit more. But as always, buy land. Rumor has it they're not making any more of it.